Hey guys, we're live. Hi David, thank you so much for coming on to Venture with Grace today.
Thank you.
Okay, so to give the audience a little bit background of David, David is a venture partner with Coolwater Capital, a GP stake investor and accelerator for emerging VC managers. He is a founder of Versatile VC, backing investment tech companies which help investors generate alpha and succeed. He is also chair of PEVCtech, a community of investors in private companies using tech and analytics to generate alpha. Welcome, David.
Thank you so much for having me. I'm excited to have the conversation.
Amazing. Okay, so what about we start with David? Like, what are you working on today, and then what are some top like priorities for you?
So Coolwater Capital, we effectively are Y Combinator for emerging VC funds. We're looking for the next generation of top performing fund managers. We help them launch, raise initial capital. What we find is a typical person who's building an emerging VC. They previously were an exited tech founder, they were product manager at a top tech company, but they very rarely were the manager, the CEO of a VC fund. At best, they were maybe a junior partner at another established VC fund. So we provide all the infrastructure for them to get off the ground and become an institutional VC. We're well aware that VC is the highest dispersion of returns of any asset class. So we're identifying the next generation of Sequoias and other top performing funds. So top priority for us is identifying those top performing managers. And I hope some of the folks in the audience today will consider applying for the Coolwater program. At Versatile VC, we're focused on how investors can use technology and analytics to accelerate alpha. Our view is, if you look at the public markets, there's a multi-decade trend towards greater use of technology and analytics. Hedge funds like D, Shaw, and Two Sigma, internally, they look more like a software company than like Warren Buffett using a pencil going through a 10K, which admittedly has worked very well for Buffett, with due respect. But we think the next generation of top performing private equity VC funds, they're going to use technology and analytics systematically in order to generate better returns and also to scale, right? Because this business has a lot of manual complexity to it. So that's why we are looking to invest in companies that sell to investors. And our community, PEVCtech, is a place where we can provide resources, provide research, and run events, helping other investors upgrade their game through use of technology analytics. So we're always looking for new folks to join our community and looking to partner with people there. I'll add one other opportunity for many of the folks in the Venture with Grace community is we have an ongoing series where we profile different investors' tech stacks. What are they using in-house to run their firm? And we're doing that because we want to help everyone upgrade their game. And it makes it much easier when you can see how your peer, another emerging manager, what choices did they make in their CRM, in their use of modern AI technologies, so that you can hopefully speed up your own process of building out your own firm.
Amazing. Well, this is such a great introduction. So I should have not introduced you. I should let you introduce yourself at the beginning. But anyway, so I have so many questions in that category of things. So like, the tech stack. Like I wonder, so to give the audience a little bit of background of like how it works, I feel like in investing, I would separate them into like three bracket of things that you need to do. Like number one is, so as a emerging manager or like solo GPs or like people who are interested in potentially starting a fund one day, there is like, the fundraising part. So you have to fundraise, and then I hope we could cover some tools and like tactics for people who fundraise. And then the middle part is like deal sourcing. You have to, VC is essentially like a sales process, not like VC, like it's kind of like a sales job, right? So like at the beginning you are selling yourself to LPs, and then you are selling yourself to like potential like the best portfolios or like best potential portfolios. And then number three, it's like you have to have an exit, you have to know how to kind of like calculate your returns, and then make sure like your portfolio is good like overall. So I wonder, to start, maybe we could talk about, in terms of like fundraising, what are things that people use to fundraise. And I want to highlight that, like, for fundraising, I could think of like, as wannabe solo GP or whatever, like I'm constantly thinking about like what is my differentiating strategy. And like, some people are highly technical and then they're really focused on deep tech. And then some people are focusing on like, a specific sector in like, consumer space. And like, I wonder, can you share more about like, what is your thinking framework? Number one, picking a strategy. Number two, like picking the right tools to go with your strategy.
So you're bringing up a lot of different issues. Let's zoom in on fundraising. Before we even talk about fundraising, we have to talk about your product, the fund that you're selling, because that's more important than your actual fundraising skill and network. The right product will excite LPs and the wrong product will not. And it doesn't matter how many wealthy individuals you know, if you have a bad product, you're not going to get much money from them. So at first think about how do you upgrade your product. In your case, your syndicate, what deals have you done? What are the returns on those deals? And what's the nature of the LPs who have invested in that syndicate, right? That's obviously a standard way now that people build up their track record as an emerging VC. If you're not already working at an institutional VC, but you want to graduate from being an angel to running a syndicate. So my general view is it's much, much easier to fundraise by getting LPs to come to you as opposed to you trying to have coffee meetings all over your city, trying to get to the LPs. You can burn up a lot of cycles doing that.
Anyway, that's a great suggestion. But how do we build to a point that like LPs will come to you?
Yeah, so there are a couple of ways you can do that. First, I'll highlight that you don't want to meet just random people with money, because if your target market is random people with money, you're competing with every other possible investment option in the universe. That is a terrible strategic positioning. What you might want to do, in my case, is meet with allocators, investors who are excited about investment technology that helps investors generate alpha. So those are usually people who work at large institutional investors, maybe lenders or hedge funds, places like that, where they realize that a lot of their firm runs in Excel and they're thinking, gee, maybe this is not best practice. Those people resonate with what we're doing. For Coolwater Capital, the LPs who tend to resonate with us are people who realize that there are disproportionate returns among emerging managers, but most institutional allocators are very shy to invest in actual emerging managers, right? The incentives of the institutional investment industry are very much weighted to invest in a fund 3 of a well-known firm. And so we are a vehicle, by nature of the fact that we have graduated at Coolwater 185 VC funds, which have collectively raised over $2 billion. We are a vehicle to plug in innovation at scale. So how do we identify those people who care about innovation at scale? Well, they're economic development agencies, right? So we're in conversation with certain government entities in certain parts of the world who want to create their own Israel, right? Their own super high-powered, greatly disproportionate innovation ecosystem. And they realize that someone who knows how to build VC funds can help them do that. And so we will make a point of participating in conferences around economic development or around innovation, because the sort of people who attend those conferences will relate to us. We also have a history of organizing events. So for example, I've been a part of organizing numerous events, and I have others in queue, which you can see on my website, around how investors can generate alpha. So who shows up for an event around family office technology? We have several events this year we're involved with around how family offices manage their internal tech stack. You could guess it. It's people who work as the CIO, chief information officer, sometimes also chief investment officer of a family office, who are sitting on, let's say, $1 billion in assets, and they realize Excel doesn't cut it. And they're thinking, okay, what do we use to grow this firm, right? So those sort of people realize that they need to upgrade their game, and those people are more likely to resonate. So I think it's a better use of time to spend a couple hours organizing an event around your particular theme than it is to go have coffee meetings with a few people. At an event, you get 100 people, and then you have the coffee meetings with a subset of the 100 people, right? But they're already pre-qualified. You already look credible to them because they saw you in a leadership role at the event. And that event did your lead gen for you. And those events could be live, could be virtual. Obviously, writing, meaning publishing content, generates leads as well. But I will say events are a lot more effective in my experience in identifying people actually writing checks. I find that when you write about stuff, you get a lot of companies who want money from you. It's much rarer to get people approach you saying, hi, I want to give you money. And that probably reflects the dynamics of how allocators think
Mhm.
as opposed to capital seekers.
Totally. I'm working on my event on February 15, and then I wonder like if you're putting together a event, who would you invite? Is that other
So
GPs
my
or is it
preferred,
like LPs or what's the theme?
so there are a couple of models that I use. One model is I partner with other people who will
Mhm.
inevitably have a non-overlapping set of LPs. And we'll
Mm,
have a friendly relationship. And I'll say, look, I'll let you come to the event, but I want you to invite 5 qualified LPs. And that brings in some people who I don't know. Another model I've used successfully in the past is I'll partner with established organizations like university alumni clubs,
mhm,
like some of the like I'm an advisor to Culture Shifting Lab, which is a group for
mhm,
Black, Brown, and other underrepresented VCs. And those sort of organizations, they have their own mailing list, their own community, and they're usually very receptive to people getting involved with them because they always want more events and more programming, right? And
mhm.
so this effectively gives me a way to tap that community's mailing list and community, and some subset of them will resonate with whatever it is that I'm selling.
Mm. I wonder, like, okay, so I think that's such a great strategy. And I wonder, like, when you're thinking about picking a niche, right? Like, so, um, a lot of the creator turned GPs or like creator turned solo GPs, especially, a lot of people were their niche is like their audience, like, so whatever their audience think they should do, kind of. But like, I wonder, like, how do you pick a solid like sector that's actually going to generate the returns, right? Like, so eventually we're selling a financial product at one point. Like, so what is the way, like, what is like the thinking framework to, pick the best niche for you in particular?
So it's very rare that someone mounts a systematic search and then picks a niche.
Mm,
I'd say the much more common dynamic is as someone who does that, I commend them for being thoughtful about it,
mm,
is people are on a certain career track for whatever reasons, right? Because of the
mhm,
major they chose in college and whatever job they happen to get post college. And then after they've done it for a few years, they say, oh, gee, I can start angel investing, then they grow up and be a VC. And so because they worked in, for sake of argument,
mhm,
semiconductors for 5 years, they're not going to be very credible investing in consumer software, right?
mhm,
They should invest in semiconductors and start there. Now, maybe if they're very successful, at a certain point, you can invest in whatever the heck you want and people will give you money. But you should always start with wherever you have the highest credibility. My
mhm,
view is that as an entrepreneur or an emerging manager, you should be as little creative as possible,
mhm,
right? You should try and have a natural narrative path from whatever you did previously in your life to what you're doing now, because then you have clear expertise and relationships that you can draw on. And you're already trying to recreate yourself. If you were
mhm,
previously an operator like yourself and you're reinventing yourself as a VC, right? You have a harder burden because you are making changes to how you are seen in the market. But the burden is lower when you're saying I'm investing in the sort of things that I worked in my prior life.
mhm. Totally. But what if like the sector is not as predictable? And because I feel like any consumer tech company compared to a B2B company is a lot harder. It's like B2B company, I feel like a founder have invested themselves into a certain career and then they basically if they make enough effort they will make some sort of progress with the company. But I feel like as for consumer tech company it's really hard to pick what the customer will like adapt. It's so much unpredictability. And if your sector happen to be that, like, how, like, should you change to a different sector, or like how do you see people successfully reinvent themselves into the game?
Yeah, so this is a career question. So I think about it this way. Um, in an ideal world, you have a great job with a great manager and great mentors, and you're at a great company in an industry which is growing. So,
Mhm,
for example, if you could be an HR executive at any big company, but
mhm,
if you happen to be an HR executive who's working at ChatGPT, right? Or, sorry,
mhm,
OpenAI, right? Like your value in the market is 5x what it is for everyone else,
mhm,
right? It's considered a hot company.
mhm,
So in an ideal world, you'll pick the company based both on the job that you're actually doing there and also the industry in which it is, which you believe is going to be a growth sector. I will
mhm,
emphasize this is a lot harder than it sounds. VC history is absolutely full of examples of sectors that were red hot and everyone wanted to work in them, and then it blew up. And all those people got into crypto, right? They have a lot fewer opportunities than they had a few years ago because crypto is not as hot. But that said, that it is helpful for even someone who's not an angel at all, not an investor at all. They should think like a VC and trying to identify the growth sectors of the future, because they will absolutely benefit if they are in an industry that is growing.
Totally. Okay, so let's chat about, since like our topic is about tech stacks. So I kind of like, I was thinking about how we should categorize them. Like, obviously you can see I list like 18 sub categories, chat topics, but like I wonder, when you were thinking about, like, let's say in terms of fundraising, right? Like it's a sales cycle, and then after you like create the event, how would you leverage technology to go about it?
Yeah, so the first thing is gather the data. So ideally, you have figured out the structure of your relationship with the other people involved in this event, such that you have the rights to the list of registrants, names, emails, titles, etc. Right? If you can't get that, right, because, for example, you're partnering with an entity which keeps that data tight, which I understand. So one thing I will always do is I'll download the speaker list off the website, so I have a record of that, because that's usually public. And I will make sure that I have some archived copy of the names of the people who are there, maybe because I see that they pre-registered for one of the sub workshops, because certain events, you have a little roundtable group, and sometimes you get those names. Right? You want to make sure you get all those names. And the reason is because in your follow-up email, my experience is very, very consistent. If you follow up and you say, oh, I see we're at this conference together. Oh, I see we registered for the same workshop together. You have a much higher response rate, even if you never actually interacted with a person, you didn't actually shake hands. But if they see there's this point of affinity, we're in the same room at the same time, they're much more likely to pay attention to your email. And so that is very, very helpful. Then you want to enrich that data. Tools like Clearbit are helpful for that. Let's say you only have their emails, you don't have their title and employer and their LinkedIn and so on. Clearbit and other vendors will help you to enrich all that data so you can pull it into your CRM and then follow up as appropriate. Speed absolutely matters. Ideally, you follow up within 24 hours with those people, so that you can make your pitch for whatever you're selling. Parenthetically, many, many years ago, I had a job interview with a firm, and I walked out of the interview and I went to a local Kinko's and I wrote my thank you note. I typed it, printed it out. And then I walked back and hand delivered it. And this is all within 2 hours. And the guy was like, wow, I got the job offer, right? Why? Because I was really fast. And I am sure that was the fastest thank you note he ever got from an applicant. So that model is a generalizable model.
I wonder, like, I think that's really cool. But I feel like if today let's say I meet someone at their tech company and then I go out print something, when I go back, the security will just stop me. Hey, who are you meeting today? But I really like that analogy for, like, quickly keeping in touch with these people. I feel like the moral of the story definitely applies to today's age. I wonder, like, what's your thought on, like, in terms of running the second follow-up meeting? So this is like not about tech stack, but this just come to my mind. But anyway, so let's say I meet you at a conference and I, like, later on I follow up for a coffee chat with you. How would you run these chats?
So when I go into a meeting, I always have a bullet list of the points I want to cover. And I usually try and structure it as I want the other person to talk as much as possible, because my goal is not to talk. My goal is to listen and learn. But I have some agenda, right? I'm trying to sell something, or I want to set up some sort of business relationship. So I want to make sure I cover those 3 bullets. And ideally, the other person brings it up and they say, okay, gee, I'm interested in investing in your fund. If they don't say that, then I'm going to say that and say, are you actively allocating to funds like ours? And then take it from there. So I find it very helpful to start with certain standard questions, which are, how much time do you have? And then I honor it. So if they say I have half an hour, I will flag it at the 29-minute mark and say, you mentioned only half an hour. Sometimes say, I have some flexibility. But the fact that I honor it, right, that I was paying attention, I remember they said half an hour, that says that I'm the sort of person who tracks commitments and honors whatever restrictions they have. And that, I think, sets the relationship off on a good foot. I also always start by learning more about their non-financial imperatives. So it's very, very typical that I'll meet with, say, a family office, and sure, they want to, the generic family office wants to grow their wealth and they want to not lose very much, right? That's generically how they all think. But they always have some idiosyncrasies, right? They've got some next gens who are looking for an internship. They want to invest in stuff in real estate because they made their money in real estate, right? They have some sort of wrinkles. So I always ask about that first, because I never want to be in the position of I'm just selling returns, right? Because as we talked about earlier, that's the worst possible competitive situation to be in. I want to sell, I'm selling access to innovation. I'm selling access to the next generation of elite VC funds. I'm selling access to direct investments into the top performing companies of the next cohort of 2024 startups. And different people will resonate with different extras that I can offer, but I want to know in advance.
So basically you're selling some sort of information of like innovation as well as like selling, some insights technically for that coffee meeting.
So many years ago, I worked in an advertising agency. And in advertising, there's this aphorism that people buy on the sizzle and they justify on the steak. In other words, they'll say that they invest because, oh, you had great returns, but they're really investing because of emotion and other factors. And that is, in my experience, very much true, right? And so I try and understand what are their emotional drivers, what are their other goals they're serving, because there are always multiple ways to justify investing in a fund that has good returns or doesn't have returns because it's a startup fund. But if you can hit their other goals, then you are more likely to actually win the sale.
How would you walk through these meetings? I found it really hard to, this is just me walking through this kind of like sales cycle situation into my hat, right? So like if someone come to me and ask me to invest, so I have like actually some people have reached out to me over LinkedIn about like their funds, and then they walk me through a full-on pitch without me even realizing I was being pitched, because I was getting these connecting calls and then people start pitching. And then I was like, what am I getting myself into? And like, so I feel like I wonder, like, I didn't really want to create any experience for people who go into a coffee meeting with me to be like hearing my full-on pitch of a certain subject, or like here's my 45 industry insights. Like how would you run this in a less like just like weird way to like make sure that people understand what you're doing, but also like they're like kind of prepared? So I don't want people to be like, oh, actually we don't invest in like this sector, or like, this is too small of a track, or like too whatever. So like basically I wonder, how would you kind of like run this? And then, since we're talking about technology, like what is like the 5 tools that you would use to build a system to do it in a more scalable way?
So what you're referring to is qualifying. And so one of my standard questions is, to qualify them, are you actively investing in funds? And what check size do you write? And if they say no, the conversation is going to go down a different path. And maybe I'll just end the conversation early and say, I don't think this is a fit and I don't think I can be helpful, right? I don't want to waste their time or my time. If they can't say that they're actively investing funds, then it's not a good fit. And these people who are approaching you, that's their fault, right? They should qualify you. And if you're not personally an investor in funds, they might want to meet with you for their other reasons. But if their goal is fundraising right now from Grace and you're not investing funds, that doesn't make sense. To your question about scalability, so I've wrestled with this for a long time. So typically I get pings regularly from people like, hey, let's get together for coffee. So almost all the time they're looking for money or a job, right? Those are the top two. Occasionally a date. I'm less.
You're married, okay? I'm
no, they don't want to date with me. They're hoping I know someone.
Oh, okay.
My wife doesn't let me date. So I will ask that. I'll say, like, how can I be helpful? What's the goal? Because I'll never meet with someone without some indication of what the goal is. Because again, I don't want to waste my time. and it's actually, I don't think it reflects very well on them if they don't tell me up front, right? That, like, I want to know. It's a perfectly reasonable question on my part to say what's the goal, and I'd rather just be upfront. They're looking for money, and then maybe I can help them, maybe not. Maybe I'll invest, maybe not. So I have a pretty high bar for taking a meeting because there's sort of an endless deluge of people who want to meet. And I'd much rather have a quick email exchange and point them to a past blog post than spend half an hour doing the same thing. And in fact, that's partly how I've ended up writing so much in my blog, is because I've had so many meetings in my life and I sort of say the same thing over and over again, which I think is typical for a lot of business people, right? You have certain scripts you use. So I just convert the script into a blog post and then publish it. And then I point to that in order to allow me to scale my time. So that's actually probably my number one point of advice on that is I've been writing for a long time because I've been meeting with people for many years, and they fall into these patterns over and over again. And so I found that to be a big time saver to publish the sanitized versions of my notes and then use my blog as my public repository of notes on different topics on which I have expertise.
I love that. And by the way, everyone should check out David's blog. And it's just one of the most like well-rounded blog because there's just so much topics and so much. It's like a Wikipedia of you. You should create a David like GPT or something to just answer people's questions by using your blog's information. This is like so much information going on. But anyway, okay. Let's talk about like the tech stack, right? Like so after like what are you using to kind of like pre-qualify people? Like is there any place besides like a pitch book? Do people use pitch book to like do like due diligence, or like how are people doing due diligence on LPs? And then I saw that like some of my friends came and share like they met up with like thousands of LPs and then like hundreds of them land, but like I think to meet with like 2,000 LPs is like a challenge for people. How do you even get that many people to pitch to? And to having thousands of conversation to pitch, like I know a lot of people do that on Zoom, and like I wonder what does that look like? Can you give us like a rundown of like how people are doing these things?
Is your question about how you originate the names of LPs?
Yeah, and then also like qualify them or pre-qualify them, or like doing due diligence about if something is legit, and then if yeah, in general.
Yeah, so I'll tell you a story. A friend of mine was at a GP LP conference where it's basically a dating platform for GPs and LPs, and he met with a guy. And after talking with him for a bit, he said, you're a wealthy guy, but you're clearly not here to invest, right? Like just you could tell from the Q&A. He said, what are you doing here? And then I said, well, I told them I'm a wealthy person, which I am, and I got a free pass to this conference for a couple of days and free food and drink, and I got to meet interesting people, and that's why I'm here. So that's, from my point of view, that's a huge waste of time, right? If I'm raising money to meet with that individual, and that's why you have to qualify people. So I've definitely been in situations where I meet with people and I think the conversation is about them investing in me, and it turns out they really want me to invest in them, in their startup or whatever.
So welcome to the VC ecosystem.
Exactly. So I will first clarify by saying, are you actively investing? I'm not subtle about that in funds of the type like what we're doing. And how many investments like this have you made in the past? If they've never made an investment in a fund, that is it's pretty unlikely you're going to be their maiden entry into the world of being an LP. And then there's also a whole question about actually making sure the money's legit. It's not, from Russia and on a blacklist. So there are a variety of vendors out there that will do your KYC AML for you. But I assume your conversation is more at the level of, are they people who actually have money to write checks? Another crude heuristic is look up their home address and look at their house, right? There are definitely wealthy people who have houses that they can't afford. And they may have a lot more debt than, but that's certainly a crude heuristic that I've used in certain cases just to understand something about their budget. And I ask questions about their family as well to understand a little bit about where they're coming from and also identify points of commonality. And that usually provides some tells. But I found that there are people who live way below their means, people who live well above their means. And so it's not as indicative as you might think. How people dress, especially in tech, right, is often quite misleading. So the real question is, are you investing in funds? What type of funds are you investing in? What type of funds have you invested in the past? Those are the most important qualifiers.
I've seen people with very little amount of track record who are like successfully raised and without basically like a lot of like without a lot of indication of they will be a good fund manager. Well, they turn out to be good or whatever, but like obviously if you heard of them, they're technically assuming they're good. So I wonder like so and then I also heard about the advice of like raising 3 fund altogether. Um like so I wonder what would be the process like to you mentioned about like checking people's home address. I assume that's for more of like a wealthy individual as for your first fund, but like I think there's like a couple things there. Like number one is like if they're wealthy individual, even they're wealthy, they're still an individual, right? This is like not like a pension fund or like any other like institutional fund. Like people have more like emotions if things are not going right? So I wonder um as for people raising their first fund, um, is there a place that like where you can see like all the LPs in like one place, like a Forbes Midas list for like the top investors, or Forbes 30 for founders or whatever. Like, so I wonder, is there some sort of list that kind of like indicates that these people are interested in investing, and do people find that on PitchBook, or like what tools do they use to get on there?
So sorry, I was trying to join the live chat.
Yeah.
Okay.
Hi,
I,
Tegan.
I
Nice
just
to
put
meet
in,
you. Yeah.
Tegan, I know Tegan. I just put in a link. Maybe you could just recopy it over to the comments. So I track the lists of LPs who focus on emerging managers on my blog. So I would go to that link for my public database of it. Those lists are not quite as helpful as you think, because the reality is that what really matters is, do you resonate with that particular investor, right? So there are vendors out there who will sell you lists of thousands and thousands of names of high net worth individuals with their emails, and they're of limited value because cold emails don't have much value, right? You need to figure out which ones will actually get excited about what you're doing, and that depends on your particular strategy. The people you mentioned who have raised with a pretty limited track record, there's always a story, right? Maybe they were a star engineer at their prior company, so everyone who knows them says this person's going on to great things. Maybe they're from a family that's very well connected. There's always some reason that someone is able to successfully raise money with what appears to be a limited track record.
Totally. What is like so basically like how do you build the track record, like, or okay, so let's say if we find out that that person is like a wealthy individual by looking up their home address, what are things that we should do to like kind of keep the conversation going? And then after our first coffee chat, we kind of pre-qualify if they're interested. And then when you're reaching out to them, do you have to have a pitch deck ready? What level of preparation you need to do before you go out there to pitch yourself? And after they say, I'm kind of interested in committing X amount of dollar, like how do you keep basically like keep like qualify like how do you keeping them into the loop? Although I listed so many tools there, but like I'm not exactly sure how people technically use them to keeping people in the loop.
In terms of what you should have, so I absolutely think you should have a deck, which effectively is your business plan, before you start soliciting people. I know someone who raised a $70 million fund and didn't even have a deck. Why? Because he had successfully founded a company that grew to significant scale. But I think that's just not good corporate management, right? Like if you're going to commit for the next 10 years to go manage money for a bunch of people, you should at least have put some thought into what's the strategy, what's the fund construction. You should not be making up the stuff on the fly, right? It's to me sort of crazy not to invest that level of energy in planning ahead. Like, I know people love the lean startup and pivoting and sort of acting on the fly, but I think that good manager requires you to do some planning as to what the heck you're trying to build. So with regard to the question about how to keep them in the loop, so my framework is not how to keep them in the loop. My framework is how do I close them, right? So ideally, if we have a meeting and it seems positive, I will make sure to say, okay, what are next steps? What additional information will help you make a decision? And they will often say, I want to look at your data room or whatever, right? So fine. So I'll say, okay, can we schedule a follow meeting? And that puts pressure on them to look at the data room before that next meeting. And then that meeting, I'll say, oh, did you have any questions? Do you have a chance to look at the data room? And how much would you like to invest? Right now, inevitably, there's some people who say, I want to wait till the final close. And so then they'll, Grace, if you could please share that link in comments for Renee.
Yeah. Cool.
Great to see some friends of mine in the chat. So inevitably for those people, you want to ideally you have a mailing list where you can send them periodic updates. But mailing lists that are just, here's the awesome stuff I'm doing, people unsubscribe from those really fast, right? So you ideally figure out some other way to add value to your community, like share with them the events you're involved with them, share with them new research. So for example, I use Diigo, D-I-I-G-O, which is a tagging company. And I use that to tag the sites that have information relevant to what I'm interested in. And that serves my needs to just track my information. But that feed creates content that then is useful for other people who care about investment tech and emerging managers and things like that, right? So I'm always interested in how do I, at low marginal cost, because I don't want to commit to write an essay a day, create relevant content for my followers. Similarly, I have a public events calendar. Unsurprisingly, the sort of events that I'm involved in are events related to emerging managers and investment tech and diversity and other things that interest me. And so people in that ecosystem, they find that helpful as well, and gives them also a reason to stay engaged with me. And so they'll sign up for my mailing list, they'll sign up on the blog, and that reminds them that I exist. And then hopefully we'll have some business relationship later on.
Totally. Hi, Renee. Hi, Wayman. So I wonder, when you were thinking about so managing your fund, right? Like, what does a back office look like? And then you mentioned about data room for the audience who are maybe racing for the first time. Can you elaborate more about everything?
So I am a little hesitant to give tech recommendations in a vacuum because it depends on what you're comfortable with, what you know. I'd say the foundational technology that I would recommend is a CRM, because this is a relationship-driven business. I know a number of funds that started with an Airtable or a Google Sheet, but inevitably it doesn't scale. So I think it's absolutely worth the money. I did an extensive search on this. I wrote a blog post around what is the optimal CRM and marketing tech stack for an emerging VC. For me, I ended up using HubSpot. And one of the reasons was, as soon as I signed up with HubSpot, I turned off Calendly because I didn't need it anymore. I turned off MailChimp because I didn't need them anymore. And I turned off about 3 other tools because HubSpot was a one-stop shop for all of those tools. HubSpot also has a startup program, which you as a VC can likely qualify for, where you pay 10% of the regular price. Obviously, it ramps. By year 3, you're in a paid market price, but that helps to make the cost more affordable. So I think it's a mistake to try and do it with just spreadsheets and Google Sheets early on, because it's never, ever going to scale, right? You can't build an institutional firm by relying on that. And there's always this huge pain of moving the data over. So I'd suggest, bite the bullet and pay for a real CRM earlier.
So in the audience, Chair mentioned, what platform do you use for your data room?
So if you're an emerging manager, you're cost sensitive. So DocSend is the most commonly used tool, I would say, for most folks for a data room, and probably suffices. That's what I've been using. And then there's a question from Tegan who asked about what percentage of meetings did you give a miss to? Did you reject a founder that later went on to be a decent deal? So I don't have the exact data, but I certainly have some past experiences or anecdotes of companies where I'm like, I should have invested in them. Carta, we looked at years ago and didn't invest because just for whatever reasons at that time. And that's inevitable. That's the nature of the VC industry, that you're going to see lots of companies that some chunk of which go on to be winners. There's another company where we turned them down because they had some huge red flags in DD, like what looked like fraud. And then the company ended up exiting for a very nice amount. And it may still have been fraud, but the founders built something that someone else found value in.
I wonder, like, I want to circle back on like the point of, after like how we close the deal, right? Like after we do these events and then after we kind of update them within our mail ecosystem. You mentioned using HubSpot for like kind of like follow up, right? So I personally like to keep like everything more casual. Like I heard that from other friends as well. So like people are communicating between like WhatsApps and other things. I kind of feel like it's really hard to keep on track of something. So I wonder if there's any tool that's, or like, some people would build leveraging Zapier or whatever, like connecting all the tools together. And I wonder, I feel like some of the tools are overkill. And then like, I just started using Superhuman, but like I feel like it's good, but it's also like maybe I'm like not really getting the essence of it. I haven't really found it like to most I didn't really make the most out of the platform yet. So I wonder what are like some tools that you feel like is essential for people to look at, and then instead of like we kind of like build our own like tool pack or like toolbox, what are something that's like you feel like it's working for most of the emerging fund managers?
So I'm a Superhuman user, really like it. I use it sort of like my own little ChatGPT writer because I have so many templates stored there. And I've gotten very fast at I get a certain standard inquiry and I hit the standard response and boom. So I don't need to go to ChatGPT anymore to go draft a response because I have something queued up that's appropriate for that particular person with some minor modifications. They're ridiculously overpriced, by the way. It's one of the most expensive personal productivity tools in the market.
Wait, which one is?
Superhuman. If you look at their pricing compared with other tools that sell to a lone wolf user. But I'm still paying it, I admit. So clearly I'm getting some value. But if I found another vendor with some functionality, I would jump on it. It's somewhat interesting to me. I haven't used their AI functionality, which is built in. And LinkedIn also has some built-in AI tools, and I just haven't used it much. And I think the reason is because so many of my posts are short. And so the time to tell the AI what to do and then edit what the AI outputs, it's faster for me just to write it. That may reflect the fact I'm a fast typist and I'm a fast writer. But I'm surprised at how I'm not using AI much for short stuff. My use of AI for writing is exclusively for longer things, like I have to write a 2-page analysis of something. Then it's helpful for doing a first draft of it or aggregating data or so stuff like that. So other tools, I'd say DocSend, very heavily used. We talked about that earlier by emerging managers. And then LinkedIn, especially as Twitter is busy, I would argue self-destructing. I started to use LinkedIn more aggressively because there are real people there and there's very little obnoxious Nazi, offensive behavior on LinkedIn. So it's just a more pleasant place to be. And so I've been ramping that up and I'm looking for tools to do that more effectively. Then another tool that I see a lot of people use is Airtable as effectively a MVP for certain internal data sharing use cases. I talked earlier about using it instead of a CRM. And if you're a small firm, you're very cost sensitive. I get it. That's why people do it. It's just not the long-term solution because it is offering you 2% of the functionality of a real CRM.
So after like let's say like we use after like, so I'm just going back to like in reality how these tools applied into our daily life, right? So after we go to the event, we create it, and then we send out mass email through HubSpot to these people to follow up. And then we go there, follow up, whatever, like using Zoom. Like, do you prefer to meet people face to face, or do you feel like Zoom is okay?
So my hierarchy is face-to-face, phone call, and then Zoom. So
Phone
especially during
call?
COVID,
Really?
yeah, especially during COVID, I got really burnt out on doing Zooms. I spent enough of my life looking at screens. I don't want to look at screens more. And so on my personal scheduling link, I default to phone calls, and then people can request a Zoom if they want. Because I find that and there's some academic research supporting this, that it just creates more mental wear and tear to look at a screen, some picture of someone's. I'm happy to look at them live, right? That's great. But I'd rather have the ability to walk around and just not feel tied to the screen. The way you are on a Zoom, where the social protocols, you have to look at the person, even though you're really looking at a picture of the person, and that creates extra friction. I also say that inevitably there are pop-ups and distracting things in my computer screen. And so I'd rather just turn off the screen and then just talk with the person on the old-fashioned phone.
I wonder when you are okay. So after that, we kind of like follow up with them over like like step stack again by like sending them more like follow up email to them, and then at what point we close?
Well, as they said as they say, always be closing, right? So this is one of the biggest challenges of merging managers is you very, very often hear from LPs, love what you're doing, very exciting. I want to invest in the final close, right?
Yeah.
So how the heck do you actually get the money now when you need it to get to your first close? In fact, there's a well-known allocator in New York who specializes in diverse fund managers, and they're called first close partners, right? Because their whole sales pitch is, we help you get to your first close. Good for them.
Oh my God. I'm
So
sorry.
so I've talked with a bunch of people. No one has a good solution. I certainly in the past, I've used certain incentives, like financial incentives, where you get benefits if you commit to a first close. I think that helps, but it's not a magic potion where people suddenly are dramatically more likely to invest early. I find, if anything, sadly, it's the slightly less sophisticated investors. We're talking about retail, not institutional, who will sometimes invest in the first close because they don't think through the option value of waiting till the final close, right? Where you effectively are buying not into a blind pool, but a pool where you already have some assets. The sophisticated investors will say, "Oh, I'll invest in the final close," and I'll say to them, "Well, we need the money now." So it's sort of just a maddening aspect of fundraising for a fund. What I try and emphasize is that we still have discretion in our LPs. Right? So often people invest with a goal to getting co-invests, and I'll subtly highlight that the LPs who come in early, we're going to particularly keep them in mind when they're direct investment opportunities, right? So it's not the sort of thing you put in a contract, but typically, but hopefully they realize that if they're willing to cut the check now, then they're more likely to get the call when Sequoia is leading around one of my companies, one of the companies we're linked to, and they want to co-invest in that deal.
Mm. Um, how do you convince the first like signal investor? We're not talking about like convincing a regular investor like my friend or whatever. Like I'm talking about like a Sequoia or whatever, like they would invest in you so others see the signal, then they would invest.
Yeah, so signal investor depends on your industry, right? If Kim Kardashian invested in us, I'm not sure, like she's well known, but it's not really strategically relevant. Although, yes, we will take her money if she's listening to this discussion.
Please listen, Kim, please.
That's right. That's right.
Going for it.
We'll put her photo on the website.
Yeah.
So I would say that you ideally those sort of folks, you want to pitch them to be a venture partner with your firm, an advisory board member, and investor, right? The cash is the real commitment, but something else where you get the ability to use them in the deck. And you want to emphasize them that you recognize that they're an influencer. They can really add value to you beyond just their money. And you're going to honor that by featuring them in whatever way they want. right? Some people
Mm.
want to be behind the scenes, other people want to be prominent on your website. Um, so that goes to the earlier question of what are their real goals? What are their emotional goals? And if someone says, I've had people say to me, I feel like I'm sort of unknown, like people don't know who I am. I'm trying to raise my visibility in the industry. Okay, so I can help the person do that, right? Put them on the website, put them on a podcast, introduce them to conference organizers, stuff like that. Um, and so, so I would generally, as you think about the hierarchy of whom you meet with for fundraising, I would start with the people who will give you honest feedback. That's super important, right? So those are usually your friends. It's very hard to get honest feedback from investors. Then once you've done that, ideally 10 times, and your pitch is refined, your deck is refined, then you move to the less experienced investors, who are usually the people who are not the lighthouse signal clients, right? But those are the people where hopefully can get a little bit of momentum, because the hardest part of all is being the very first commitment, right? So I'd rather meet with, say, the well-known CEO once I could say we have a couple of mid-level executive type investors, because then the CEO type is more likely to feel, okay, I'm lending my name, I know my name is value, but some other people have already committed.
When so a lot of people are thinking about building a network of, let's say, like these like Fortune 500 executives or whatever, like SLPs, right? Would they actually help? Because I feel like unless they have like enough stake in the game, that's actually going to move needle. Like, do you see people like after they back a certain fund actually help the portfolio?
Yes, I've seen it, but it's not a simple financial calculation of, oh, I've invested X dollars in that fund, so I'll put more energy in their companies versus this other fund where I wrote a little tiny check, right? A lot of this is driven by, did you ask for help, right? The more you ask for help with specific queries, the more responsive people are. I know one platform for investors where they have certain standard asks, and they find that people in their community will sometimes help out companies even if they have no direct financial investment, just because who's a typical investor? It's often a semi-retired person, right? They've got time on their hands, they have expertise, and they want to be relevant. They want to be involved with some young, exciting entrepreneur. And this is a way they can do it. So that it's really, the burden is on you to make the ask and nudge the person to help out. And it's kind of like one of the rules in multi-level marketing is the 3-foot rule. Anyone within 3 feet of you, you solicit. So if you're fundraising, anyone within 3 feet of you, you have to ask them for money or ask them for an intro as appropriate, because you are going to get rejected a lot. You just have to budget for that. And you got to go out there and hustle and take the pain, take the no's.
How many no's do you like? I feel like when like, so if you're like pitching for your fund, at what point do you feel like this is actually a no? Or like, you know, you always hear about these story of like people pitching before the investor finally one land. And then I feel like after I pitch, let's say if I pitch 20 people and then no one say anything, I would just quit at that point. What is like a good signal of like if you're doing something meaningful and like it's just not the right person, or like what's a benchmark of like this is it, like you should leave, not you but like the person.
So I think of this question as, should you pivot, right? I mean, should you change your model based on market feedback? Should you persist and just be bullheaded and keep pushing? And entrepreneurial history is full of founders who kept pushing along in the face of obstacles. Or do you plank and declare defeat? I'm dead. I'm going to go get a job somewhere. So I would say that whatever you're doing, you're building a startup, you're building a fund, you need to show new wins at least every quarter, right? That means you get a new team member join you, get a new LP to come in. If you can't do that, if you can't get anyone to give you a win other than yourself and your core team who are already there, that's a sign that maybe you should pivot or perish, right? Because I said earlier that VC history is full of people who just persisted, but it's also full of people who persisted for 10 years and they had nothing to show for it, right? Or 5 years, whatever, right? So it's very, very difficult to decide, are you the smart person who's persisting to face obstacles going to be a winner, or are you just being stupid and you should just shut it down and go do something else? And so that's why I'm proposing this quarterly heuristic of, do you get some meaningful wins in that quarter that show that someone out there besides you thinks that your startup has merit?
Mm,
So I think this is one of the reasons why I think that startups should pay their founders something, because if you maybe have savings, so you don't think you need a salary, but you have a huge opportunity cost. If you're qualified to be CEO of a startup, that your time has value, right? And you are completely ignoring that if you don't pay yourself a salary, right? And or at least very explicitly think about it and talk with your partner about this, if you have a partner, because you're losing that opportunity cost every month that you get by going back to your old job.
mm. I guess like if your first fund turned out to be terrible, or let's say because we're in a startup land, let's say you lead like 5 syndicates and then they none of them like move forward to something. Like how would you turn that into a fund? Or maybe you're just like shit investor should not do that at all. Not
Well,
you, but like the person.
yeah. So the reality is there's a lot of luck in this business, and there's certainly people who lost money in their first 5 investments, and then they have a winner. So I would say that the people who found emerging VCs are the most overqualified, underpaid people on the planet, right? The sort of person who founds a VC, they were a product manager at Google, they were an exit tech entrepreneur, they could do stuff where they're earning some very meaningful amount of money, and they choose to launch a fund where typically you're not going to make any money for the first few years. And then maybe you make some money if you get carry, but many funds never actually generate carry, right? Um, so I think you should be well aware that this is at best a get rich slow industry. And we're seeing now this washing out of people who got into VC because it was hot and exciting and they thought they'd get rich quick. And those people are fading out because they realize, oh, wait, a lot of risk, a lot of illiquidity. You have to make a long-term commitment to this. You have to stay in the game long enough to actually catch an up cycle and get some winners.
Mm. I was the other day I was listening to Samel from Haystack, like he was talking about like his early days, how hard it was for him to like get started. I don't think it was like how hard it was, but it was about like he was like, you know, um I don't know, like I just hear about like these like solo GP stories. They are really interesting, and then people don't really imagine. People just imagine you're like so rich, and then so you're like investing. But some other people, I feel like a lot of people work really hard to create their own path and create their own fun. Um, I wonder when you were thinking about the management fees, like so some people are I chat with other VCs and then they mention like, oh, one of the advantage could be, you know, you just don't charge management fees. And I heard some people raise $1 million fund and then they never charge anything. And I wonder like is that a good way to go? Or like because, you know, if you don't really pay yourself and then you're like, you know, working on this thing and then like are you really motivated? And like are you I guess like is this like actually gonna effectively help you close bigger checks?
So I think that very few people make decisions on investing based primarily on the fees. In
Mm,
fact, when I was in business school, we had the number 2 guy from the Yale Endowment come in, and he said they did an analysis of the correlation between post fee returns
mm,
and fees.
mm,
And you might a priori think, well, the higher the fees, the worse your post fee returns. They found the reverse. The more they paid in fees to funds, the higher the post fee returns. And the reason was the top performing funds, the Sequoias of the world, can charge higher fees, but they actually delivered, right? So who cares that you're paying them 30% carry because you're getting great returns. Um,
mm,
so uh, in fact, if anything, I think when people see that you're charging below market fees, they think, why are you doing that? Right? You're supposed to be an
mm,
economic animal. And you're showing that you're not able to raise capital on regular fees. So I'm generally pretty skeptical of thinking that this is going to solve your problems.
mm,
Um, I'm because there's definitely negative signaling associated with it. I'll give
mm,
you a creative example. I know a fund in Europe. This is a hedge fund, and when you invest, you have the choice of 3 fund structures. You can pay them 2 and 20, or 1 and 30, or 0 and 40. Once you commit, you
mhm,
can't change it. But I really like that, right? Because they're saying we're happy to share the risk, right? But then you have to pay us more. And I think it gets around the signaling bias. They're comfortable not taking management fees and running the business without them. but there's a cost to that.
Hmm. Okay. On that note, I know we're running out of time. Thank you so much, David. Do you have time to address our one of our audience last question, or do you feel like we need to move on?
So we had one question about have you ever invested in a company that failed and then invested in them again? So yes, I and certainly other people in VC have invested in people who failed on round one, usually because we said, look, they failed, failure happens, but they did a great job in managing the company by the failure, right? So it's like a football coach. Inevitably, they lose some games, but if we feel they managed the team well, they did the best they could given the circumstances, and then their lead athlete got a big accident and was out of commission, not their fault. So that's the real test, is to do the attribution analysis of why the failure happened.
Thank you so much, David. Thank you so much, the audience, for coming. And okay, so David, do you want to share with us where can we find you?
Sure. So best way to find me is at Teten.com. If you're an emerging fund manager, check out Coolwatercap.com and apply for our accelerator program. We're the top rated accelerator for emerging managers in the industry. And if you're interested in investment technology, join us at PEVCtech.com. We run events and publish research around how you can accelerate returns using our technology.
Amazing. Thank you so much, David. What a great conversation. Okay, I'm going to end the stream right now.